right, everyone. Welcome to the ASBN Life After Residency seminar. This series is really designed to empower residents and fellows as you start thinking about your life after residency, some of the things that you don't necessarily consider or cover in your residency programs that are absolutely integral when you become faculty and moving to the real world of neurosurgery practice. We have two incredibly experienced speakers, and I'm really excited about both of these speakers. Wort, who is one of the leading financial advisors in the country, works a lot with medical doctors at all the top institutions. So he's here to share some tips about what to do when you start getting compensated, what to do with your money. And that would be followed by Dr. Eddie Zusman, who is a dear colleague and friend and mentor. And Dr. Zusman has held every position you could imagine in neurosurgery. She has been a CEO, she has been an adjunct professor, she has run different organizations and centers, and she has worked in several boards of directors. So she brings a wealth of experience and is able to help navigate how to pick your practice and structure and think about your first 5 years. So I welcome both of you. I'm very, very excited. I think Kyle, you're going to go first, and then Dr. Zusman will follow up next.
Well, I appreciate the very gracious introduction. So as a firm, we're with Larson Financial. On the call also is my brother and business partner, Rob. But we were there from the get-go at a firm that really pioneered the idea that not only are physicians good clients later on when obviously paychecks are high and money is being made, but also that they need a lot of help at the stage in the game that you guys are at, right? And it's kind of a shame because not a lot of groups talk to residents and fellows because you're not making any money yet. And, unfortunately, a lot of different firms in our industry are solely after that transaction, whereas we want to build relationships. And, when I started at this firm, I think we had, I don't know, maybe 8 advisors total, and maybe a staff or 2 for each individual. Now we're sitting at, I believe, 92 advisors and 350 back office staff and trade platforms and investment, trade teams to support all of that. 6.9 billion in assets, I believe, is where we're at right now. And then even more on the private side, which is a whole nother aspect that we've gotten into as a firm. But all of those were built on the foundation of physicians have this very unique scenario where you guys normally have a lot of debt. You're starting your career much, much later than the individual that just goes to undergrad and then pops into the workforce. You work almost double the hours of anyone else. And on top of that, and it's no skin off your guys' back, but usually little to zero education throughout all of your years in undergrad, grad, med school, residency, fellowship, no education in business, right? I mean, you guys are lucky if you have one intro to business class in undergrad, and then from that on, and rightly so, right? Guess what? I didn't take any medical classes in undergrad either, right? I was a finance major, so it's okay. But all of these things point to the reality of is that we saw as a group of potential clients that you guys needed help, not just when you made the money, but the steps in order to prevent taking steps backwards prior to that point, which is residency, fellowship, first year in, etc. So with that, what I'll say here is I'll give a little spiel on, our firm, myself. I'll start in on some talking points that I think are very important for not just residents and fellows, but really any physician out there. And then what I really want this to be is an open discussion with the minimal time we have. And it's a little smaller group than I anticipated, which is, in my opinion, very good. And it can be more of an open discussion if you guys are willing. If not, I'll go through what I think are important talking points, and that'll be good. But feel free to type in things that you want to know on the chat, subjects that you want to talk about, questions that you have. I know there's a Q&A session at the end of this, but again, I want everyone to be engaged, right? If you're not, then what are we all doing here, right? So I want to talk about things that you guys want to hear, okay? So that being said, Larson Financial, like I said, I've been at the company 13 years. I think we've been in existence for 15. I'm one of the original partners at the firm. Like I said earlier, we founded ourselves on the idea of helping physicians thrive. Our mission statement is literally empowering physicians to flourish. And that's what we're here for. We are, without a doubt, the largest independent and fiduciary financial firms. Those are two big words that I want you guys to remember, and I'll circle back that at the end of my talk here. But that works primarily with physicians. And when I say primarily with physicians, I probably currently have maybe 140 clients, of which 2 households are non-physicians. One is my parents, one is my grandmother. So we see what you guys are struggling with, what your hurdles are, what the advantages are, and the strategies that you guys need to apply as physicians, especially in your specialties, as if not the highest, one of the highest specialties in terms of income in all of medicine. So that being said, I'll just dive in, right? So in our method of planning, like I said, we go into this like a long-term relationship with every client that we take on. We effectively, in a nutshell, if you were to consider yourselves as a money-making entity or a company, if you will, we want to step in next to you being the CEO of that company, and we want to be your CFO. A lot of people think that your financial advisor or your wealth planner is just there to sell you insurance and manage your money. And I personally, but again, us as an entire firm, we really want to go well beyond that. So that it's not just the things like, how should I invest money in my brokerage account, or how much should I be saving, or pure retirement forecasting, but it's also things like, should I buy or lease that car? I got a sign-on bonus. Should I put it towards my student loans or throw part of it in a Roth IRA? I know the speaker after this is really going to talk to entering into positions and what practice to pick and things like that. But like I said, out of all of our clients, probably 98% of them are physicians, and we saw the advantage of becoming members of the MGMA. So we can provide things on compensation data and RVU thresholds and dollar per RVU, and are you hitting a good threshold? Where are you in the percentiles based on academia or hospital based? Or I know private's not huge in your specialty, but there are some out there, and we want to really just come to the table for you in literally anything having to do with money, whether that's spending it, taking out debt, investing, estate planning, taxes, everything across the board. So I know I have a lot of residents and fellows in the room, so I'll kind of start with the building blocks, right? So we go step by step. And what I mean by that is, before we can have our eyes in the sky and think, oh man, I'm going to get that 850K salary in a year, and you're picking out what color Ferrari and all this other stuff. We want to make sure that we're not going backwards before we get to that point. And I kind of make a silly question I pose to everybody is, what do you guys think is your biggest asset? and this is same for someone that's 1 or 2 or probably even 5 years into practice. A lot of times I get the house we just bought, or my parents left me an inheritance of a couple $100,000 or whatever it is, right? The real answer is you. You guys are your biggest asset, right? You have to do a physical and nature performance of your specialty to go and see patients, earn that money, and build that wealth. And so, without a doubt, whether you work with us or not, I would tell every single one of you to make sure you are covering that biggest asset, which is yourselves, aka go and take out a correct, what I would call own occupation, specialty specific, what kind of slang is double dip disability policy for yourselves 100% before you even worry about anything else that I ever talk about for the rest of this or anything past that. You are what's going to drive your income. You are what's going to build your wealth to those 7, 8, even 9-figure net worth. Why not protect it first so that you don't take massive steps backwards before you can take that first step forward? I also say do it in residency and fellowship. And again, even if it's not with us, this is free advice, right? I'm not soliciting you guys to come on and work with us. Obviously, we would love if you wanted to, or you were even interested in talking about that. But I'm telling everybody, whether you work with me for the next 30 years or you never ever see me again, every single one of you should have the correct tier 3 own occupation disability coverage 100% before you do anything else. So take that to the bank. Past that point, right? Let's say we're done and we start. Now we have a huge student loan, maybe not, right? Maybe you're one of the lucky ones, but most do. And we look at the rate, and now it's been out for a while now, but we have the public service loan forgiveness. So some people are aimed at obtaining that to kind of erase that debt. That plays into a factor. Do we want to just pay it off with a sign-on bonus versus what do we do, right? The first thing you do, and we would obviously do this for you if you came on as a client, but we want to build a solid budget / cash flow analysis on what's coming in, what's going out, and what do we need in emergency reserve. So again, these are things, right, that you might not think that somebody like me does, but it all circles back. And if I'm going in with this relationship as I want to be your right-hand man in anything to do with money for life, I want to make sure that we have a solid foundation before we go and do things that, yes, I do actually get compensated for, right? It's that old, we do not want to put the cart before the horse saying, right? So without a doubt, the next thing that I work on with my clients is what do they have in emergency cash reserve? So you might think like you sign on the dotted line, you get that big sign-on bonus, you go buy that big house, and that first paycheck comes in, and I'm going to be on your heels to save that. I am, but not in the term of investing, right? We want to self-insure what I would call a little tiny black hole that we have before that disability policy that I said would actually kick in and start paying you if, God forbid, something happened to you guys. So in any case, there's a couple of rules of thumb with that. You don't want to go too much in cash. I would obviously dive into this more on a specific basis, with every client that I have. But without a doubt, we always want at least 3 months of whatever you're spending in cash, just checking, savings. I don't really care what. I want it to be easily accessible to you at the drop of a hat. Why I say that baseline is a 3 month is because there's really only 5 carriers that give you guys the type of disability coverage that you need. And they all start paying out that benefit in the, unfortunate event of you guys being injured or sick or just in any case, unable to work after 90 days. So your options really are you build that amount up in cash, or you could go and get like a short-term disability AFLAC policy, which in my humble recommendation is not worth the paper it's written on. They don't pay out that much. They're extremely expensive, and they're gonna maybe pay you for 6 months to a year, 180 days, something like that. Okay. I would rather just have that amount in your bank account, and you guys will see really quickly your check will probably equal that in 2 months. You can do that. You guys are all going to be making big dollars. So why pay a premium for something when I can just do it myself at zero cost? Past that point, that's when the skies open up and we really start to talk through, what are we going to do? Pay off debt, invest. If we invest, where do we invest? There is a variety of accounts that are taxed differently, have different liquidity levels, have different taxation in retirement. And what we really look to do is holistically plan all of that based on a taxation standpoint, based on a risk reward standpoint, and then inevitably based on an estate passing on to family or the charity of your choice, or just whoever you want to leave your money to. So that being said, there's a lot of, discrepancy on things where people will say they work with physicians, and then I'll hear silly things like, in a first meeting, I'll tell someone to put money into a Roth IRA, for example, which I will say again right now, if you take something else to the bank right next to the disability that I recommend everybody get before they're done with training, Roth IRA is the #2 automatic 100% thing that everyone in this room, including the practicing physicians and the speakers and myself and my brother and everyone that hears me speak, should put their first dollars into every single year. Let alone someone who will inevitably be in the highest tax bracket for the rest of your lives. I'm talking to all of you folks here. So the way a Roth IRA works, you throw money in. It's currently limited at 7K. If you're under the age of 50, if you're 50 or older, you can bump up to $8,000 a year per individual. Not a lot of money for what you guys are going to make. However, once you put it in that, it is completely tax-free growth, provided that you do not pull it out before 59 and a half years of age. Like I said, even in retirement, my anticipation is that you guys will be in the highest tax bracket for the rest of your lives. So how advantageous is it for you to have an amount of money growing tax deferred and coming out tax free in retirement? So 100%, without a doubt, every single year I tell people to do that, but you have to be careful. And here's why. So there is an income phase out of 230K. Every single person in this room, again, whether you work 0.25 FTE or your full boat or your hospital-based RVU, no one in this room is going to make anywhere near less than that amount. So you have to do this, what's called backdoor Roth IRA conversion, to get the money in there. Effectively, it's just an extra step for the Roth IRA to be funded, because anyone, regardless of income, can fund a traditional IRA. Then we tell you, or we tell your accountant, or if you work with our accountants, we are obviously not going to deduct that amount that we put in the traditional IRA. And then anyone with traditional IRA dollars can convert to the Roth IRA.
Kyle,
one extra step.
Interject real quick. I'm sorry. We have a couple questions. I just wanted to backtrack before you get off.
Yeah.
If you open up chat, it says,
oh yeah, here we go.
Yeah, if you want to read them and just
real quick. Own occupation, specialty specific, very important. I shouldn't have glossed over that. You guys are all neurosurgeons. That means that these 5 carriers that really are the only ones out there that even have this type of coverage, that means that they will cover you specifically as a neurosurgeon. And if you can't do that, they will pay. They do not care if you go and teach or start a medical device and it makes $1 million, whatever. As long as you cannot do what they insured you for, aka being a neurosurgeon, they will pay that benefit. And you can still go and work and earn other income in other ways, right? I make the argument that you guys are very, very talented, very educated, and there's a myriad of ways that you could make money outside of just going and doing brain surgery, right? I think everyone can agree on that. The problem is disability, unfortunately, it's not going to pay, the benefit is not going to be what you're making current income dollar for dollar. Everyone will take a pay cut no matter what, right? Obviously, they don't want to incentivize people to go on claim. So the nuts and bolts of that is you'll take a pay cut, right? But if you still have all this knowledge and education and worth, but you just can't go do surgery, you're probably going to go do something else. Expert witness cases is a big one. Speaking of Duke guys, we worked with, John Sampson out of Duke for a long time. Guy did a ton of expert witness cases, huge income. He didn't have specialty specific double dip. And he realizes that all that income coming in from doing an expert witness cases, 1, 2, 3, 4, 5 times a year would have siphoned off the benefit from his current carrier. Our CEO and myself pointed that out to him in his dining room, and he was not happy. He had paid a huge premium on that policy for probably 20 years at that point, and we pointed out to him that because of all his outside income that he made, the benefit on his current policy would have been zero. So that is the own occupation, and the double dip part is where they pay you out no matter what for that specialty, and they don't care what else you go do as long as it's not going back to doing surgery. I think everyone can kind of really quickly nod their head and say, yeah, if I'm making $7, $8, $1 million, I want to protect that, right? That is built on you doing surgery. It's unfortunate that just seeing patients doesn't get you guys that money. And it can in other aspects, but we obviously, our income is driven by, performing those surgeries. We want to protect that. And we want the option to continue to go and use our expertise elsewhere to supplement our income in that, unfortunate event. Does that answer that question? And even just to pipe in, I don't want everybody to be muted. You can pipe up and say, yeah, or just shoot it on the chat. But that in a nutshell is 100%. If it is not, and I'll just give you the carriers. So if you don't see that carrier, don't get it. I don't care if they tell you it's specialty specific. It's not. We are independent. I don't have an insurance company that I work for or anything like that. We go and pick who we choose for our clients because it's the best coverage. It's standard, Emeritus, Guardian, Principal, and the other one is Mass Mutual in certain states, but usually Mass Mutual isn't competitive anyways. And usually Guardian isn't competitive either. It's very good, but it's also about double the price. So if you didn't hear one of those carriers and somebody's telling you, I don't want to throw under the bus, but I will because I think they flat out lie to people. Northwestern Mutual is not specialty specific own occupation double dip. That is a tiered policy like I just talked about our old client, where the income siphons off for any outside source that you're making money. It will cover you as a neurosurgeon, but you literally have to sit at home for the rest of your life if you're on claim. You cannot make $1 in other income, or they will reduce your benefit by that $1 that you make. So that's my tidbit on DI. Extremely important for you guys. Let me know if we've got any questions and we can dive into that later.
On average, how much is the I don't know if you're at liberty to say, and this might not be a reasonable question because we have a lot of residents and fellows in the call.
Yeah,
but
cost.
How much does that pay out in the event that you need to file a claim?
Well, so the payout is specifically based off of your income that you are making. So you start out like in residency, it's $5K that is the max that they'll give you. $5K per month of after tax, AKA tax-free benefit would be coming to you if you're in residency. Then if you have a signed contract and you're 180 days out of going into practice, they will bump that to $7,500 per month tax-free benefit. Then after that, it's completely based off of a couple of things. One is how much are you making in income? So they'll get your W-2, your tax returns, 1099s, K1s, whatever all your income sources are from that particular, line of work that you're doing. Obviously, everyone here neurosurgeon. Then they will also look at what your group disability policy is, because they're not going to over insure anyone. And that goes for it's not per carrier, that's period. Every insurance company out there is going to do that. Excuse me, I'm getting over one of these colds. So the cost, roughly, unfortunately, for all the women in the room, it's a little bit more expensive for you guys. You guys can have babies, and that's a risk to these insurance companies. So it's a little bit more expensive, but I don't know, Rob, what would you say? Maybe for the $5,000 starting out per monthly benefit, you're probably looking at somewhere between 150 and 200, give or take.
Yeah,
Things like the state you're in,
exactly.
sex makes a difference. And then obviously it tiers up from there. As your income goes up, you can obtain more benefit. The key is this though, guys. Why I said do it in residency and fellowship is because if you went through us, for example, we have like, I don't know, 12,000 physician clients. These disability carriers see us as a gold mine, frankly. And what they do is they extend anywhere from a 15 to a 30%, depending on the carrier, discount on the policy for life. So do the math on something like that, not just in residency, but when you guys are making 700 grand and your benefit it could be, a couple of my neurosurgeons have $30,000 of disability benefit if something happened to them per monthly basis. The premiums on that are close to 10K a year. That's $3,000 right there every single year that you're saving, just because you obtained that right before you went into practice when you were still in training. It doesn't cost you any more or less, than it normally would if you went after outside of that discount. So I 100% say, and again, that's why I said, number one thing, take to the bank. You walk away, you don't ever see me again. Get disability in one of those carriers that I mentioned before you go into practice. Cool. So I saw another thing on here: pay loans first or invest in the market. This is 100% what I was going to get into when we start talking investing. So it's a great question. There is no one answer to that, right? It depends on the debt, and it depends on the investment as well. So without a doubt, I don't care what kind of debt you have out there. I tell everyone in this room, max out your Roth IRAs first and foremost, because maybe credit card debt is right there, 1 and 1A, with things that we want to get rid of, with our extra money, right? Compared to putting that $7,000 into a Roth IRA. But if you think of tax-free growth compounding from now until you're 59 and a half or longer, at your inevitable highest tax bracket, it's really hard to beat a tax-free, tax-deferred compounding growth in a Roth IRA. So, but credit card debt is right there with it. That's the only debt that actually compounds on itself, other than like your student loans when they're in forbearance and you're not paying them back. It does cap for that little amount of time. But then past that point, it's simple interest. So even if you're paying 7%, it's a flat 7 every year. It doesn't add on and add on and add on. Where if you're making 7% in the market, it's 7% stacked on itself every single year. And obviously it's not guaranteed and whatnot. And so there's risk to take into that. But to me, it's a math equation, right? And like I said, you guys are the CEOs, I'm the CFO. So I know that there's a personal anguish inside a lot of people in it and how it relates towards debt. That's not what I'm there for. I am there to give you the pros and cons via the black and white math equation that I would do. Mainly saying, all right, look, we have a 50K sign-on bonus. We have student loans that are currently, let's say, at almost 9 times out of 10, 6.8 is that like sweet spot. Okay. I'd go through things like, are they Stafford or are they private? Big reason for that is Stafford loans, federal Stafford loans, Sallie Mae, Fannie, all that stuff, that follows you to the grave. So if you, morbid to talk about, you die, those are forgiven. Private, not so much. You guys have kids, you guys have beneficiaries, wives, family members, that trickles down to them. That's a little bit more risk to me, right? But then inevitably, I base it off of what is it costing us in interest, AKA if we put that money towards the debt, that's what we would save, right? Versus if we took that same amount of money and put it into some type of investment, what would we make? As that spread gets larger and larger, one way or the other, that's what dictates me to make a recommendation one way or the other. There's also things like, I'm a long time, Nena I know she's not in the call today, but she's a longtime client of mine. I think we've worked together for 8-9 years. We had a long discussion when she bought her first house about wanting to pay it off insanely quickly. She was super lucky where her mortgage is like I don't know, 3.1. I don't have it in front of me, but super, super low. But she wanted to pay out the whole thing as soon as she can, really nice salary. I won't dive into details, but she wanted to pay off her house in 5 years. And I did a really quick analysis. I said, look, you have a little tiny interest rate. You also get to deduct that interest rate off of your taxes every year. You're in the highest tax bracket. Your net rate, I think it was like 1.9% net after tax of what she was paying. And then I said, look, even if we average the same 3.25% that she had on her mortgage in the market, it was going to be like an extra $600,000 at the end of that 30 years in her net worth. And then I said, hey, but wait, we're not going to make 3.25. We might make 8. So I showed her 8, and it was like $6 million difference. It might not seem like that, but that is the power of compounding. And so that's why, again, back to the CEO, CFO comparison, I'm here to lay those details and variables out on the table to you, give you the pros and cons of all of them, and then step back and say, what do you want to do? It's your money, it's your life, it's your situation, it's your family, your company. It's your final decision. I'm there to lay the cards out, educate you, and make a recommendation, and then step back. And I think that, as probably to wrap up here, so I know I only maybe have 5 minutes left.
You have more than that because we've been asking questions back and forth, so you can go through 150.
Cool. So what I tell everyone is, in a nutshell, again, back to the whether you work with us or not, that's what you want. You want someone who is making those recommendations, like, again, back to the CEO, CFO. CFO, yeah, they get paid a nice cush salary, but you know what they really make money on? The company doing well. Okay. That share price goes up. They're tied to that. Their bonus is usually tied to that. They usually get awarded share prices, right? We are no different. We set up our compensation in a way that when you do better, we do better. When you do worse, we do worse. So if and only if, you want to just trust us because you say, well, yeah, if they're going to make more money if I do well, then what Kyle is telling me is without a doubt what he believes will grow my net worth in one way or the other. And that might not be something that we get directly compensated on. This is pertinent to the people in this room. A big thing that I look at that is investment related that doesn't have anything to do with us is surgery centers. A lot of times my surgeons across all specialties can buy into these surgery centers. We go through the financials. We look at it just like we would if we were investing our dollars. And the reason being, because if that's a good investment and that money comes back to them in their household, and then they in turn are in a better place cash flow or budget wise, there's more money to invest. That money is invested accordingly to the way we want to per their risk purview. Everybody wins. Okay. That is what is called a fiduciary. All right. And at the end of the day, I think every single one of you should do one of two things. You should either educate yourselves in a way that you can do everything that we do for our clients yourselves. And I will be the first to tell you that if you have that drive and that want and the time, you all are smarter than me in this room. You can do so. But we're a very large and very fast growing company because that's normally not the case. Usually when you guys get off a 65-hour work week and it's 6:30 p.m., you just want to go see your wife or your husband or your kids or go take a hike or whatever. You don't necessarily want to go rebalance your portfolio or make sure that you're covered correctly on your umbrella policy, or make sure that you're abiding by the backdoor Roth guidelines, or all these just little minutia that we do for our clients. But you without a doubt can. Okay. So one thing is like educate yourself and do it yourself. That's free, right? You don't have to pay a guy like me or Rob. However, if you decide that you do not want to do that yourself and that you do need help, which is usually the case, whether it's us or somebody else, you 100% want a fiduciary. And that is a person like myself and Rob that is held to a higher standard. So think more licenses, steeper penalties for not doing your job correctly. You cannot work for a captive agency. So, not to throw Northwestern Mutual under the bus, but they work for a company that owns product that effectively compensates them 3 times amount the money for their products versus other products. Now they say they're independent because, hey, technically they can go sell something else, but they get paid like 25% versus 80. What are they going to do, right? Are they really in your best interest? Whereas we get paid the same from every carrier under the sun. Every investment is just based on a percentage base. There is we can move in and out and invest the way we want and cover you in terms of asset protection the way that we think is the best. And that is the way it should be. And the nuts and bolts of being a fiduciary is just basically, if it can be proven that I did not do what was in my client's best interest, I can lose my licenses, I can get fined, and if it's bad enough, I can go to jail. Whereas a commissioned base, what I would call transactional advisor, they just have to say whatever I did was suitable, which could mean you could come and say, hey, you know what? I kind of think I need life insurance. They show you one company, boom, you sign on the dotted line, and you might not even know that it was 50% more than 5 other carriers out there. We are shopping continuously every single carrier out there, every investment. I'll give you a really good, quick example that will give you an idea of the lengths we go to save our clients money. I just got done saying earlier, we manage about $6.9 billion of our clients' money. Forever, a huge holding, obviously, is the S&P 500 index ETF. I think there was 1.2 billion in that ETF alone throughout all of our client book of business. We moved that full amount of the $1.2 million over to the SPDR S&P 500 ETF because it was 0.03% cheaper on the expense to the fund company. We didn't make any more money from that. It was obviously also a very big undertaking. However, it's the exact same investment to a T. And if we can charge you, or if we can save you guys 3 basis points on that transaction, that's what our firm does. That's what I think in a nutshell is what your advisor should do, is just be your right-hand man, like they're your best friend, and tell you what they would do if they were in your situation across the board. So I know I'm kind of coming up on time here. I know we're going to do a Q&A at the end, but I thought I would just kind of open this up to verbal questions, or if you're not comfortable with that, throw it on the chat. But I'm here to be an open book. But in a nutshell, know that if it's not me, if you are going with an advisor, make sure they're really working for you and not working for themselves or another company. Is kind of what I would say to you guys. So with that, questions.
We've got some more time, so I'm going to ask two questions.
Yep.
The first is, how do you pick an advisor? So they're coming out, you're here, you're obviously quite engaging. I've known you for quite some time. You work with them. I don't work with you personally. So what tips and tricks do you have for the audience on what they should look for? I love the explanation about the fiduciary responsibility. What other tips and tricks do you have?
In terms of looking for an advisor, it's tough. I mean, I'd say probably more than half of my client base has come from referrals. That's good in some regards, but then you can also kind of just fall into getting referred to somebody by a client that may not really know what their advisor's doing for them. In a nutshell, a bad example of that is one of my really good buddies that I golf with a lot here. His daughter goes to school with my daughter. I'm big on, I'm not that guy at a party that's going to throw their business card out and try to get everyone's business and whatnot. I did not do this for that. I like the idea of strategically being efficient with dollars. And that's why I joined. That's why I do what I do. I do not want to be the salesman that emails people and calls them all day and whatever. That's not me. Never has been, never will be. But as people learn what I do and they know that I've been doing this for a very, very long time, 16 years all in all, they start to ask questions. And this friend of mine got referred. I feel like I'm bagging on him a lot today, but whatever, it's the truth. He got referred to a Northwestern Mutual agent, and he had all these crazy whole life insurances and all this stuff. And I really quickly just said, you're not going to like this, but I just did a quick calculator on what would have happened if you put all that insurance money into the S&P 500 and then just had a term policy for your needs in terms of asset protection. He's only 41, and it was like $1.2 million difference as of today. If he continued to do that for another 10 years, who knows what it would be? I mean, millions and millions of dollars gone to commission, to insurance that he doesn't need. We're here to build wealth, right? In terms of picking, I think there's things that matter to people. Some of my older clients transitioned away from me to other advisors in our network that were local, right? So is it something where literally being physically face-to-face matters to you? That's one thing that I'll say probably hampers the level of planning that you might get, but it's not to say that there's not good people all over the place, but it's hard, right? It's hard to find them. I think without a doubt, as I said this multiple times, have to be a fiduciary and have to be independent. An easy way to tell if someone's truly independent is if you see their signature or they hand you a physical business card or a virtual card like they do now. If you see that logo and that logo says New York Life, Mass Mutual, Principal, which isn't even a good carrier, right? Who do they work for? Do they work for you or do they work for that insurance company? They work for that insurance company. Whereas Larson, and there's a ton of other independent firms out there that do not own product. So when we make a recommendation, we're not recommending our stuff. We're going out into the entire financial world and picking what we feel is the best for you based on our expertise, and also laying out the reasons why, but additionally some cons that might come with that. It's a really hard question, honestly. I mean, because you don't really know what you're going to get until you're 2-3 years in. And sometimes that can be a really bad setting you back 2 to 3 years. Like my friend, unfortunately, in his, scenario, it was like 8 years that he set back now. One other thing that we've really dove into that. I know no one at this stage is, kind of ready to do yet, nor can you by the laws, but we've really dove into the private equity market. I know when I talk to physicians, that's a no-no word. Usually when private equity comes in and buys up your hospitals and whatnot, it's a bad thing. This is not that. We build large scale residential, industrial investors. Our client base can get in from the ground up on things like, well, here, really quickly, let me share my screen. So like, here's the one we just finished in November. This is outside of Phoenix. Huge apartment complex. Your money, you're a direct, you can't see it?
No.
There we go. Got that?
Yep, now we can see it.
So this is just the website. This thing has like, I think 8 leases left in it. But it's a direct investment into things like this, large scale, real estate based private equity stuff. And this is kind of in the step-by-step thing, that I was talking about our planning. This is the last thing that we do because you don't have liquidity, but what it provides is very, very good returns on the backside. But yeah, I know I'm about a minute over, but yeah, in a nutshell, walk away with anything. I'll give you 3 things. 1, own occupation, specialty specific, double dip, disability in training, get that discount, save that money. Without a doubt, everyone in this room, max out a Roth IRA before you do anything else with your extra money. And then 3, if you're not going to do it yourself, 100% choose an independent fiduciary advisor that has your best interests above theirs. And you can tell that by, if someone has worked with the advisor that they refer to you for 6 months, that might be a little too early. Whereas if it's 8 years in, you're probably going to be good off. And like I said, this is probably the 3rd bit of marketing that I have done in 2 years. Because at this point, I'm getting referrals from my existing clients. I guess because I'm patting myself on the back a little bit here, I feel that I do a good job for them. And they in turn happen to talk about that to their friends and colleagues. And then if they're interested or they're in a spot where they're looking for them, then they'll come, shoot me a message. And from there, honestly, guys, the other thing is just, we're not pushy either. Part of that is because of the stage of the game that we are in. I know, back in the day, I 100% had to post up at residency and fellowship programs, and I was, plate to mouth, and everyone's got to get their feet wet that way. You guys too, right? But then you get to the point where you might pick the cases that you don't want and do, and things like that. And so it's another thing that I think is important, because that we're making the recommendation for the long-term relationship, not the short-term commission or fee or whatever. So
I'll tell you, this has been excellent. For everyone on the call, you could see their contact information for both Kyle and Rob. And Kyle, this information is going to go into onto the ASBN site. We are going to use some of this content throughout the course of the year. We send out tens and hundreds of digital content every year. So this is going to feature a lot of digital platforms. And I actually learned quite a bit. I've been out of practice now for a few years, but I learned a few things today that I didn't know, which is a good thing. So
I hope for.
Yes, I am so grateful for your presentation, and I'm sure everyone else is as well.